Meet Jason and Tiffany. One of their cars has begun burning through money for repairs about as fast as it burns oil. It's really time to trade it in, and Jason and Tiffany have done their homework. They've researched different makes and models, they know what options they want, and even what color, and they found a dealer they like and trust. But now they're at a crossroads. They've agreed on everything except the one item that could actually cost them the most money or save them the most: how to pay for their new car. Jason wants to finance it through their credit union. The rate is really good, and because they've been planning ahead, they have enough for a good down payment to keep their monthly payments low. Tiffany wants to lease the car. She likes the idea of a low down payment, lower monthly payments, and turning in the car in a few years for another new car. But Jason's father says that since they have enough in savings to completely cover the cost of the car, they should just take the money out of the credit union, pay cash for the car, and rebuild their account over 4 years. He says that's the smart way to do it. So what to do? Flip a coin, draw straws, pick a method out of a hat? Fortunately, Tiffany had a better plan. She said they should talk with their Bank on Yourself authorized advisor, Becky. After all, Becky helped them create a safe and guaranteed retirement saving strategy. And besides, hadn't she said something about using their Bank on Yourself plan to fire their banker and become their own source of financing? So that's how Tiffany, Jason, and their trusted advisor found themselves on a 3-way phone call. Becky first asked Jason and Tiffany to look just a few years into the future. She pointed out that when they finance a car, they take out a loan and pay it back with interest on a preset schedule. Then she asked, "What will you have to show for your money after the loan is paid off?" Well, Jason could picture the answer: only a used car worth whatever its trade-in value happened to be. Tiffany wanted to know about leasing. After all, the monthly payments could be less than traditional financing. Becky asked, "What will you have to show when your lease is up?" Tiffany realized they'd turn the car in and have nothing to show for their money. Becky told them leasing is actually the least efficient way to purchase something. That's when Jason asked about simply withdrawing the money from their credit union account and paying cash, as his father had suggested. Becky asked them how much interest they'd be earning on the money they pulled out of their account. Neither Jason nor Tiffany, not even Jason's dad, had thought of that. But of course, they'd stop earning interest the day they took the money out, and they would only start earning interest again very slowly as they put money back into their account. You see, the reality is you finance everything you buy because you either pay interest when you finance or lease, or you lose the interest and investment income you could have had if you'd kept the money invested instead. Becky reminded them that they could bypass banks, finance, and credit card companies altogether and become their own source of financing thanks to Bank on Yourself. A Bank on Yourself plan is based on a special kind of dividend-paying whole life insurance policy, coupled with little-known options that supercharge the growth of your money in the policy and make your cash value grow significantly faster than the policies most financial experts talk about. You don't have to die to win with these policies. You can borrow against your cash value to make major purchases such as a car, a dream vacation, home remodeling, business expenses, or even a college education. And as you pay back your loan, you recapture the money in your plan to use it again and again. Then, when you're ready to retire, you can use your Bank on Yourself plan as a safe, guaranteed, and predictable retirement plan alternative. While you use the money in your Bank on Yourself plan, your policy continues to grow just as if you never touched a dime of it, if it's properly designed and from the right company. The Bank on Yourself strategy solves the problem of having to constantly interrupt the growth of your money when you spend it or invest it. As a result, you could add hundreds of thousands of dollars to your lifetime wealth simply by changing the way you make major purchases. What would you choose to do first with a Bank on Yourself plan? Buy a new car? Put in a new kitchen? Take a dream vacation? Or something entirely different? Whatever it is, get answers to your questions and find out what a Bank on Yourself plan can do for you by requesting a free, no-obligation analysis.